Welcome to this super session, and I'm talking to Paul Rickard, my colleague at the Switzer Super Report. And the big issue I want to talk about is China. Paul, China is a critically important thing to our long-term investment goals. How worried are you about China?
Peter, I don't get too worried about China. You're absolutely right, it's critical to the long term. But look, the short term, I find China really hard to understand. And look, we get so much contradictory information. Last week we had some great numbers around industrial production. The week before wasn't quite as strong. I think you look more at the colour of their money. And what you see are two things. First of all, you see that the iron ore price has been firming up. It's back over $130, and that's pretty good. You look at the statements from people like the CEO of BHP and also Rio, and they've both been pretty positive about what's going on there, and as has Fortescue. You could say they're potentially talking their book a little bit, but if you look at the colour of the money and where they're investing and what they're saying, they sound pretty confident to me.
And since the Chinese data came in last week, it was exports and imports very, very strong, retail, industrial production, all very strong. We've seen the Aussie dollar go up as well. Do you think that, in a sense, is a reinforcement for those people who are opposed to the doomsday merchants who look at China and say they're going down?
Well, it tells you the doomsday merchants are not winning the argument. The iron ore price tells you the doomsday merchants are not winning the argument. Everyone knows, I think, with the statistics that come out of China, there's no way we can know whether they're right or wrong or how manipulated they are. I take greater comfort in the fact that you've got a new government. This is a controlled economy. This is a planned economy. They're at the start of a 10-year term. If there were political pressures in China, I'd be worried, but I can't see them. So I think you've just got to sit back, take a longer term view and say, this is an economy which is industrialising really quickly. There's this massive movement of people from the cities, from the rurals to the cities. They're going to be a consumer of Australian resources for many years to come. And be a bit more upbeat about it, but not get too worried about, the week to week, purchasing managers index, whether it's up or down at 49.7 or 50.3.
Which is a guess on reality.
Which is a guess,
Okay, so let's say China, not as worrying as it was, heading in the right direction. It supports our positive view long term for stocks. Let's go to the other thing that could rock us in the short term is if Bernanke on September 17 at the FOMC meeting talks about tapering. Do you think the US market's going to sell off big time when he starts talking tapering?
Look, I'm probably of the school that the tapering has been built into the market. Now, I suppose like all commentators, you always want to qualify your remarks, Peter.
In case you're wrong.
In case you're wrong. And we're going to get some right and some wrong. But I think there's been so much talk about it. My qualification is this: if the tapering occurs when there's actually some good signs about robust growth in the US, and we're starting to see some of those, so provided that the numbers that are coming out and talking about strong growth, any sell-off is going to be really short-lived. In fact, it may have already been fully built into the price, and stocks are going to go up in price because earnings for the companies are going to be better. Pretty straightforward equation. If the growth is a bit more tepid, and we're not really seeing a lot of change in employment, and your retail sales and consumer spending are still sort of meandering along.
It's not booming.
Then I'd be a bit more worried. So I'm hoping that when they do lift the tapering, it's actually accompanied by the signs are there to say that the economy is really strong. And that's what they should be doing.
Okay, so those two big ones, probably not worrying you. Let's go back to what Templeman says, is that we get to the optimism phase, then the euphoric stage, that's when the market crashes. But do you think we're in the optimistic stage or the scepticism before becoming optimistic?
Look, I saw what you wrote yesterday about, we're in the scepticism phase, we're a long way from euphoria. I think we're still in that phase too.
There's still, we're not disagreeing.
No, well, I can, so we'll do it for the camera if you like. No, I can. But it's not euphoric. There is still so much money in cash. There are enough people still talking about Europe and all the problems there, and there are enough people overseas talking about our housing market, and is it a bubble about to bust, and all the other things they go on about. I don't think we're anywhere near that state at the moment. So, the first thing for our market is to get the election out of the way. Maybe we're seeing the pre-election boost now. As people get a little more convinced that the economy is going to get a bit of a boost from a new government, and that seems a bit more certain that that's going to happen. I think we're going to get the first thing as a test of 5,200, and at some stage this year we'll get through 5,500.
That's why I think, look, it's terrible. We try to create this thing as controversy corner, but we're agreeing, but that's a good thing. Paul, thanks for joining us. That's the super session for this week. Thanks for joining us.